Good evening, everybody. We'll get started here in a minute or two. Hope everybody's having a nice, pleasant winter evening. The honor and privilege again to have Scott Andrews with us. Scott is the president and founder of Master the Gap, Inc. He's in charge of two websites. One is closingodds.com. The other one, masterthegap.com. He's the author of Understanding Gaps and does a lot of research studies and articles on technical and quantitative trading. He was the co-founder of SciQuest and took the company public as CEO. He's earned his MBA from the University of North Carolina and graduated from the United States Military Academy at West Point. He is a veteran. So Mr. Andrews proudly served his country as an Army aviator and is a decorated veteran of the First Gulf War. So with that, Scott, it's an honor to have you here with us tonight, and we're anxious to see your information. Welcome to the Candlestick Forum.
Great. Thank you very much, Steve. I appreciate the kind introduction, and hopefully everyone can hear me okay. And appreciate the nice words, too. It was my privilege to serve our country, and thank you to all you veterans and any one of you that have loved ones from any country, any free country serving the military forces. I like to say if it weren't for free countries with people serving in the military, there'd be no free markets, and no free markets, and none of us would be here right now. So I take that very seriously and appreciate it. I only served 5 years, but I do appreciate the opportunity to be here tonight. I am back. I will warn you, if you're here because I'm sure you love Steve as much as most, I am not nearly as funny, unfortunately. Maybe funnier looking, but I'm just not as funny. And you'll hear Steve and I probably could not be more dissimilar in terms of styles, in terms of trading, which I think is probably what attracts us to one another. We're very complementary. He is a chart reading guru, as you well know. I'm not. I'm a math guy, basically. So what I'm going to take you through tonight is a topic that I basically started or stumbled on out of frustration as a gap trader. I'm known for being a gap trader primarily. That is my bread and butter. But I used to catch a lot of winning gap trades. I'm a gap fader, and meaning I would short up gaps and buy down gaps if it meets my criteria. And, I'd thump myself on the chest, be all pumped up after a 3 or 4 point win in the ES, $150 to $200 a contract, only to watch the S&P 500 futures dump another 20 points. When the market was stretched and overbought, and I knew there was a chance of that. So I started on this process a couple of years ago, this research endeavor, to try to identify when the markets were set up to make sizable trending moves so that I could better ride my winning trades or get positioned accordingly in that direction. Because if I don't have a gap trade, then I trade the 15-minute or first hour range trade, primarily breakouts, sometimes fades. So what I'm going to take you through tonight is what I learned in a 2-year project with quite a few of my customers helping me. It's all free. I'll show you how you can get the slides for free at the end. I even have a website where my core research is shared for free. I'll explain why. There's no trick here. I'm not asking you to spend a penny with me now. Even on that website, you don't have to spend a penny. I've been very fortunate to benefit from folks like Steve and other veterans in this market that have helped me grow as a trader over the years. And they've been so giving to me. I feel like this is one way I can give to others and make no bones about it. If you like my research at Closing Odds, you might check us out at masterthegap.com. I do recognize that, okay? So without further ado, let's get going. This information, I personally created all of this research. So it's no guarantee that it is correct, but I use it every single day. I believe it to be correct. You certainly should follow the same mindset that I have, which is I never, put all my eggs in one basket, never bet the farm in a single trade. It's always about sound money management, because even the very best historically attractive setups will fail on a given day. In fact, I find about 30, 35% of the time, even the best setups just aren't going to work. even if the odds were greater than that. It's just every day's a little bit different. But my edge is the fact that I'm right about 2 times out of 3, and that's enough to be pretty darn successful. So use this information at your own risk. And remember, if you're trading futures, you can lose more money than you have even in your account. So be very, very careful. So for definitional purposes, the close is the price, at least for this presentation. When I say the close, I'm talking about the price of the last trade of the regular session hours. That means 4 o'clock for the ETFs like the SPDR or the Russell or the Dow or the NASDAQ, and for the futures, 4:15. Now I'm going to start getting into some slides. I welcome questions relating to the slide that I am on. If it's not directly related to the slide I'm on, I'm going to pass over it, and I may miss it by the end. I never skip a question, time allowing. So I do welcome questions. If we haven't hit on a slide that addresses your question by the end, you'll have ample opportunity to ask me questions. That should be done in about 40 minutes or so with the formal part of this presentation, so we'll have plenty of time to answer your questions. But certainly speak up if you're a little bit confused with anything I show you. So I thought to get us started, since it is here on the East Coast, it's getting a little bit late, 8 o'clock here on the East Coast, wake some of you up if you're feeling groggy and put you in the right mindset to really understand the value of the data I'm going to be showing you and understand the opportunity it presents. I'm going to ask you to ask yourself, what were you thinking if you were trading on these days, or what would you have been thinking? And try to be honest. That's the greatest value here. So this is what a daily chart of the SPDR looked like on February 22nd last year. See a green candlestick had closed up right at the 10-day moving average, this yellow line here, after 2 red candlesticks, including an unfilled down gap from the day prior. So if you were short, maybe you got short on the break of the 10-day moving average or on the 8 EMA that I know Steve always talks about, and then you have this big down day and you're looking good, you're in the money, and then the next day you have a surprising reversal. In fact, I'm not even sure it filled the next day. It came close and powered higher back to the 10-day moving average. What is your plan for the subsequent day? Did you close some out when you got there? If you're still in it, though, what is your plan? If it gaps up, what are you going to do? If it gaps down, what are you going to do? You need to have plans, conditional situations of managing every single trade, of course. Now, the next morning, I think this is the first hour of action. I can't remember, but some early portion of the day, it had gapped up 0.5%, and I know personally I'd have been sweating. I'd probably been closed out if I was swing trading short and I was underwater at this point after just 3 days. What would you have done? What does your plan say? Maybe your stops were up here and you'd still be okay. Hopefully they were, because at the end of the day, it had closed down almost 2 percentage points. That's the actual candlestick for that day. The wrong decision not only would affect you out of a winning short trade, but it could have turned it into a losing trade. You had a winning trade that you made the wrong decision at the open. Yeah, see, someone said a pro gap. That's what it looked like, right? Back above the 10-day moving average, raging bull market, been going on for years. I honestly probably thought the same thing. I'm not a big swing trader, though, so would not have mattered to me. But I could have made the wrong decision intraday at the open. This gap not only filled, it kept on cracking. In fact, this is an example of one maybe I had an opportunity in the futures to catch a decent-sized gap fade, and I would have closed out here at the prior day's close, only to see another, 30 points in the ES, $3 in the SPDR of missed opportunity. Here's another example from June 22nd. This one to me is a little trickier. A little bit of a consolidation, maybe a break of a bull flag here to the upside. It pulls back to the 10-day moving average just underneath. Again, if you're long or short, what would you have been thinking? At least conditionally, if you get a gap down. This is the 50-day moving average, that blue line right there. And sure enough, it gaps right down to that 50-day moving average. And I had a friend who knew I had this research, and it was still in the early stages, and he asked me, it was near final stages, he asked me, what did the data show? I was just beta testing at the time. And what I told him, he didn't want to hear. He was convinced the 50-day moving average would hold because it had held 3 other times. We hadn't taken out these swing lows. No big deal. He was very confident, was not worried. But as it turned out, he ended up being stopped out, and at the very end of the day, he closed out the trade. I don't know what it did after that, but it kept on melting down. The data I had was very compelling in terms of favoring the downside at that point. Question is, what is a pro gap? Yeah, pro gap is a gap and go, or a gap that doesn't fill, basically. And people always ask me, how do you know if it's a pro gap? And I've told them I've never been wrong if you ask me at the end of the day. And I don't mean to be trite, but honestly, that's the only way to know for sure. No one knows for sure. So obviously, hopefully it's self-evident, but the better you can predict the close, the better you can do what? You can optimize your entries, optimize your exits, right? You're trying to get positioned to the short side, and you know that even though you had a big gap down, it's likely to continue down. Maybe you enter short at the beginning of the day. Or going back over here, if you were looking to get short and you get this gift and you had your really strong odds of finishing down today, boy, what a gift that would be, right? So you can't predict precisely using historical data on what's going to happen on any given day, but it can give you a very strong barometer or gauge of what is most likely to happen, and that in itself can create a tremendous advantage. And, of course, with your better entries and exits, you're going to minimize your losses and maximize your profits. So I'm going to show you some simple rules here that will help you about 25% of the trading days. And again, if you're just joining us, at the very end, I'll show you how you can get a copy of the slides at no charge. So you don't need to take notes or anything. I'd rather you focus on the concepts because concepts here are pretty powerful. And I've done a ton of research. And these are the simplest rules I could come up with that created the greatest value. Now, unfortunately, they only they're only applicable maybe 1 in 4, 1 in 5 days. But when they show up, you want to pay attention to them. So 3 factors greatly impact closing direction. The opening gap direction, the opening gap size, right? Gap direction is, are we gapping up in the morning? I'm talking about 9:30 a.m. Eastern Time, 8:30 Central Time. Are we trading above or below the prior day's close? If you're above, then the gap was up. So we're always using the prior day's close as our benchmark. Gapping up or gapping down. That in itself is hugely valuable. The size of that gap is a second criteria you want to consider. Is it what I would consider to be a common gap, a routine gap, a small gap, and I'll define that mathematically for you in a moment. And last but not least, its position relative to a 10-day moving average. I use simple moving averages. There's nothing wrong with the EMAs at all. And the differences really are not as stark as you might expect. It's 6 of one, a half dozen another. The key is to be consistent. And obviously, if something's breaking below the exponential moving average, but not the simple moving average, then maybe you discount it a little bit. I haven't done that analysis. But for purposes of this analysis I'm about to show you, it's a simple moving average. Question is, do I take into consideration the overnight high and the overnight lows? Gary, I do not. Now, that doesn't mean that there's not some value there. It adds some complexity in back testing. And frankly, the work I have done has been inconclusive at best. The volume is so light in a relative sense on the overnight, I just haven't found. I've got a couple tricks and techniques that we share at Match the Gap, but for the purposes of this, I don't consider the overnight action for predicting closing direction. Yeah, the opening gap, all I was saying about the opening gap, about the prior day closing data, that's what determines the opening gap direction, right? So if the spider closed at 180 and the next morning it's at 9:30, that's at 4 o'clock, the next Eastern, next morning at 9:30 a.m. Eastern, it opens up at 181, then you'd have obviously a dollar gap up. If it opened at 179, it'd be a gap down. That's all I'm talking about. Are you opening at 9:30 a.m.? Are you trading higher or lower than the prior day's close? All right, some key definitions you need to understand. ATR, if you're not familiar with this term, it's average true range. So I use a 5-day average true range in all this research. True range is slightly different from range in that it includes the prior closing price in order to count for any overnight gaps. You can look at Investopedia or wherever, a lot of places that define it for you. It's just basically averaging the difference between the high and the low, and if it's an unfilled prior gap, you include that prior day's close, so account for the entire move. That's ATR. I use a 5-day ATR, and that is the benchmark or the baseline that I use to calculate different size gaps. And then PF is just a simple way. It's a profit factor term that represents the ratio of historical gains to historical losses. So if you've made twice as much money as, if a strategy has made twice as much money as it's lost historically, the PF is 2. Well, more than 1. If it's less than 1, you've lost money. So 0.5 would mean that you've lost twice as much as you've gained. So just a simple measure. Most strategies are, especially just the way I'm slicing the data, are going to be between 1 and 1 point, or between 0.5 and 1.5. All right, so here's a little bit of an eye chart. Again, focus on the big picture. You won't have to give up a child to get these slides or pay me anything or sign a bunch of forms. You just insert your email and you'll be good to go and you'll be able to download these slides. So just focus on the concepts. You'll understand them when you get them. This represents the 10-year historical odds of closing above the open. 10-year historical odds of closing above the open. So everything in this presentation is oriented to where does the gap open. And I'm looking at the S&P 500 futures, highly correlated with the SPDR. If you trade the SPDR, the data is almost identical, very, very similar. And it's what are the odds of closing higher than the open? These are the up gaps. These are the down gaps. I've delineated the different size gaps between small, medium, and large using 40% increments of the 5-day ATR. So, for example, 40% of the 5-day ATR right now, it's got a couple narrow range days, but it's been like, it's probably 15 right now off the top of my head. So if or $1.50 in the SPDR. So 40% of that would be 60 cents in the SPDR. So any gap that was less than 60 cents, roughly in today's terms, would be considered a small gap. Anything greater than $1.20 would be a large gap, 80% of that. Anything in between would be a medium-sized gap. So what this does is break down accounting for different volatility, different size gaps, different directions, and it shows you the odds of closing higher or lower. Now what's interesting is a small gap up or small gap down really has no edge. They're just barely above 50% chance of closing higher, and that's just the long bias of the market showing up. Hypothetical profit factor right around 1, and net profit, this is 10 contracts, so don't worry about those numbers there. But bottom line is there's no edge if the gap is small. But if you have a sizable gap up or a sizable gap down, your edge starts becoming pretty noticeable. A sizable gap up, in general, has a 55 to 62% chance of closing above the open by the end of the day, and it's made a whole lot more money. It's made roughly, more than 40% in profits and losses historically. That's simply looking at gap size and direction, 2 of the metrics I talked about. It is very rare to find anything in which only 2 factors show that big of a difference in terms of the odds. Yes, I've got a couple examples at the end, Bill, and time allowing, I can pull up some charts and help you connect the dots. Yes, all this data is based on the, I think all these tests are run on the ES. ES and SPDR are approximately 98% correlated, depending upon how you want to measure it and time frame and all of that. Highly correlated. The data is incredibly similar. The concept is important. In fact, not only does it apply to the SPDR, it also applies to the Dow, the Russell, and the NASDAQ show very similar numbers because they're highly correlated. And again, yes, this is on 10 contracts. That doesn't matter. You can divide everything by 10. In fact, don't even look at the net profit. It's just a relative metric. Commissions and slippage not included even. So those numbers would need to come down. The more important number is the concept here. You're more likely to trend to the long side on a sizable gap up. Vice versa, on a sizable gap down, you're more likely to lose money if you go long, buying a down gap. So a lot of folks make the common mistake of buying the dips, right? You have a big gap down, and you read the book, and you said, oh, you want to buy the dips because you have a long strategy. Well, buying the dip is correct. Buying the first dip on the opening of a big gap down after during a bullish market especially, generally not a good thing. Sometimes it is, but historically over 10 years it has not made money. That normally surprises people, by the way, but it's true. So the bottom line, the larger the gap, the greater the odds of a move beyond the open away from prior close. To me, that's fairly logical, right? It tells you there was a shock to the system, some geopolitical event overnight occurred, and you had a sizable gap that caused the market consensus, if you will, on the value of these broad baskets of stocks to move quite a bit. And it's more likely to keep trending in that direction. The question is, what are the number of trades? This is the actual number of trades in the back test. So if you add all this up, that's roughly 2,000 trades over 10 years. Probably excludes like I can't remember if I excluded the gaps that were less than 1 point or 10 cents in the spider, but that's the idea there. Just a number of trades. So it gives you, these are robust numbers here, and that's, to me, makes, for such large sample sizes, these are impressive numbers to be that delineated. So let's look at the 10-day moving average, because then it gets really interesting. So we know generally you want to follow the large gaps, but the 10-day moving average makes a difference, and it could be sloping the other way, right? This is just for example purposes. If you're above the 10-day moving average and you have a large gap up, the very largest one, the large gap up here at 59%, yeah, it does have a slight edge. It's 59% chance of closing higher, but prop factor was a lot less than what I just showed you, right? Which was 1.4. So it's basically no edge if you're above the 10-day moving average and you have a large gap up. And in fact, a small gap up, you want to be thinking about shorting that. Small gap up during a bull market, you would have made more money historically shorting it. But look down here. That's where the money's been made. So the key takeaway is large gaps up when below the 10-day moving average. Remember, large gap up at a medium or large, I should say. Larger gaps up. At least 40% of the 5-day ATR in size have a 65% historical win rate and a prop factor of 2 using an end-of-day stop. What that means is that you go longer the open and you close it at the end of the day. These are remarkable numbers, extremely strong number. You made twice as much historically as you would have lost without an intraday stop even in place. That's pretty powerful. Now, vice versa, where was the money made on the larger down gaps? Exact opposite. So when you're above the 10-day moving average, see these numbers? 45 to 53% odds of closing higher, and profit factor 0.6 to 0.7, so it's lost a bunch of money going long. That means the better direction is to go short. Yet if you're already below the 10-day moving average, 50-50 down here for the most part. So here's a summary. Odds of closing higher are highest if a gap is large enough after closing below the 10-day moving average. That's a subtlety. It's the prior day closed below the 10-day moving average. It's not where the gap is occurring. It's where the prior day closed, because that's what the trigger is. It's lowest if the gap is large and down and above the 10-day moving average. So that's when you want to be thinking about going short. Whoops. Have I combined these to show the, I've got the number of trades somewhere, but the same 2,000 trades fall out into these areas here, right? You now have 12 areas as opposed to just the 6. So basically, you can slash each of these numbers in half roughly. Markets have a bull bias. They spend a little bit more time above the 10-day moving average than below it. Please explain that again. I'll just leave it up there and let it soak in for a minute. I'm going to take a sip of water. I had kidney stones. You want to drink water. You do not want kidney stones. Mine were so big. One was 1.25 inches. There was no way they could use shockwave treatment to break it up and for me to pass them. So I had to go in and drill a hole into my back 4 inches deep, put a tube in, and break them up and suck them out. It has been terrible. I've become a girly man. I used to think I was tough. I'm not tough anymore, man. It was bad. Question is that a typo? Less than 10 DMA in 0.1? No. Odds of closing higher are highest if the gap is large and up. So in the morning at 9:30, so imagine going to bed finishing the day below a 10-day moving average. The next morning you see a big gap up. You were below the 10-day moving average and have a large gap up. You should be thinking odds of closing higher are greater today. And here's why. See this? If you're below the 10-day moving average and you have a large gap up, you have a 65% chance of closing higher that day. You'll historically have made twice as much as you've lost. These are all simple moving averages. Question is, do you always trade the direction of the gap? No, I'm a gap fader. I short up gaps, buy down gaps. I'm a contrarian. I go the opposite direction of the gap, except for when you see scenarios such as on this chart. I also had a question, how long do you stay in the trade? I don't want to get into my gap trading. I've got tons of data to match the gap, and I've done entire presentations over the years on it. Check us out at Match the Gap. My average trade historically has lasted an hour and a half. I was in today's trades until 3:15. I shorted today, used a big enough stop, thankfully, that endured the heat. Got my first target hit for +2, tightened my stop per my plan, and got stopped for -2, ended up with a scratch trade. Gap sizes. Again, this was shown a couple slides earlier, so if you're just joining us. Small gap is less than 40% of the 5-day average true range. Medium gap is 40 to 80% of the 5-day ATR. Large gap is greater than 80% of the ATR. Let's continue on. So I've covered rules, and let it sink in. They're really not hard. It'll become second nature to you when you look at the charts a little bit and compare it with the data I'm showing you, and it'll make sense to you as well. Unfortunately, they don't help you. You don't get this set up all that frequently. So what about the rest of the time? Well, that's where I really had to dig in and do some pretty heavy lifting. And don't worry, I'm going to show you how you can get access to my research at the end. Or you can, I'm going to teach you how you can create your own. I'll just show you exactly what I did. This is not rocket science. It does take some effort, though. So this is how I calculate closing direction probabilities each day. I look at 10 years of data, so 2,500 trading days. I look at the direction, size of the opening gap. What I mean by Bayesian is a concept. Thomas Bayes was a famous mathematician. He was frowned upon, laughed at, and when he disclosed one of his key theorems was that probabilities of an event happening can be improved by using more recent information. So that's the concept of Bayesian. A lot of people predict the odds of the market being higher or lower tomorrow, but they do it at the end of the day. And you probably read some of the newsletters, not nearly as valuable as waiting till the open using the direction and size of the opening gap. So that was one of my key breakthroughs here, and it fits with who I am and what I do. I'm a gap trader. So wait for the opening gap and make your decision. You can't do anything at aftermarket hours anyhow if you're trading the ETFs, right? So got to wait till the open. May as well consider the direction and size of the gap before you make a decision. And what I realized is that there was no magic bullet, unfortunately, as you probably could have guessed. There are no holy grails. So the model I've created is akin to what the weather forecasters do here on the East Coast and, well, everywhere in the world, for predicting the path of a hurricane. So if you ever seen those hurricane maps where they show the odds of where it's most likely to go, most probable path, and they show like one standard deviation away from it, and it shows the swath that cuts. I'm doing essentially the exact same thing to predict the odds of the market going up or down on a given day. I'm using 5 different market models where I've tweaked different inputs that give a slightly different view. I have a different look-back period for each, and they're lowly correlated, as lowly correlated as I can make them. So when those 5 different systems is what they are, they're actually back-tested systems. I could trade them individually. I don't. I only trade when they all align, or 4 of the 5 align. But when they align, using these different factors I'm going to show you, my odds of success go up. So these are the ways I've organized these systems. You cannot put all the different factors and filters into a single system. You wouldn't have any sample size. So I've organized them in groups of like-minded concepts, calling, these are common terms, and I don't want to get into a game of nomenclature, but for lack of better term is what made logical sense to me. This is how I define them. I have a set of trend filters into one system that determine, I have a set of momentum filters, volatility filters, overbought, oversold filters, and seasonality filters. We'll go through each very quickly. Trend is just like it sounds, right? It's the general directional market. There are a lot of ways to define that. None are necessarily better than others. To me, I'm really most concerned with one thing. Where are we relative to where we've been over X period of time? So in this case, we're right at the highs. That's a very strong trend. Can these apply to individual stocks? Absolutely. Now, I don't know that Baidu would track with it. Green Mountain Coffee or any of those other high flyers. But stocks that correlate, most stocks do correlate with the S&P 500 or technology stock with the NASDAQ 100. And absolutely, this will give you some insight because, as you probably well know, the sectors and the broader indices drive, I think, more than 50% of a stock's most likely direction in a given day. Exception being individual high-flying momentum stocks like can be hanging out near the highs, but maybe momentum is stalled because you've basically been in the same area for 2 or 3 weeks. And that's what that shows here is that the trend was still up right here, but momentum had waned. We'd been in the same range for 2 or 3 weeks. Momentum waned. The odds of a big down move were increasing, and that's what happened. Volatility, simple concept here, really a lot of ways to, this is probably a misnomer, but a lot of ways to measure volatility. I'm really talking about, are we in a period of contraction or expansion? The odds of another expansion day after one big expansion day are actually lower on average. Odds of a big move after multiple consolidation days go up. That's a great example there. Overbought, oversold. This is classic Bollinger Bands. Really couldn't find anything else. I found because they tend to move around, and I don't know, this is too subjective for me, but in general, I'm not a good chart trader. I've told you that. However, measuring where you are relative to, say, a 20 or 21 period moving average is very helpful. And you can measure that and break it down into standard deviations. And it's fascinating to watch the odds of the market closing up or down based upon a small or large gap up or down in certain layers or percentages away from indeed get overbought. And all of a sudden, what a large gap that would normally be weak may actually be bullish and vice versa. And then last but not least, seasonality. Yeah, sorry about the sound. I can't control that. The recording should have it perfectly, though, we're hoping. So just listen to the recording. Seasonality, primarily I'm talking about day of week. Most notably, is it a Monday or a Friday? And I do have a slight, I have another filter, basically rising or declining into that day that has not been used. So the key for me was that I have no filters that are used that are the same in any of those 5 systems, not a single one. I have different look-back periods as well. They all test out very lowly correlated, but they're all strong and logically sound in their own right. What I did not do, and I want to be crystal clear on this because I spent a lot of time creating systems and teaching people how to do that, and a lot of people make this mistake. I did not run a single optimization. So one of the big mistakes you can do with the backtesting system is you can run optimization to determine the optimal target or the optimal stop or the optimal moving average or the optimal ATR, etc. And when you do that, it's a form of curve fitting, basically fitting your test to what's happened in the past. And that's going to guarantee disappointment. What this is doing instead is taking very powerful, logical, proven concepts, not just by evaluating every single market every single day across those 5 systems and telling you what has happened historically when those exact same conditions were in play. And if the majority of those models are lining up, your confidence should go up. And before I continue, I'm going to have to ask Steve or Becky to please boot Sam Ice. That's a joke, by the way. He couldn't get into West Point, so he had to settle for Annapolis. I don't know Sam, but Sam, I appreciate it. 2013, here's an example. This is what the charts look like. Market was in a big downtrend, and talking heads were saying we could be in big trouble. This is October, the market's stretched, overbought. Will we get an October crash like we've had in '87 and blah, blah, blah. Well, this is what my data showed. And by the way, this is one set of data. So, not one set of data. This is the average, the weighted average of my 5 systems. So go back to these 5 systems. Each system creates historical data that gets dumped into my database each night. And then what I'm showing you here is the average on what it showed after this day. So the opening area for the S&P for the next day. So I looked at this chart and I had, we were talking about what's it likely to do tomorrow if we gap up or gap down and so on. And you can see here a large gap up, very large gap up, greater than 80% of the 5-day ATR. That's what that equals to. From there, 1663 to 1648, had a 74% chance of closing above the open. It seemed illogical to some traders and some of my customers. They thought that was a great opportunity to get short. I told them I would not get short. Instead, I was going to trust the data. They argued, well, it's only 34 trades. I said, well, true, but even if we gap down a little bit smaller than that, that sample size, 55% chance of closing higher, which is not a big edge, but 55 versus 45, math on that's roughly 20% greater chance of closing higher, and more importantly, it's made twice as much. The gains have been twice as big as the losses. That sample size is 131. Anyhow, and I'm not trying to sit and act like I'm right all the time. I'm not. I'm wrong plenty of times. My historical track record, though, for trading is today I was right. A big one, this particular day I was up, gap up of 1% right into confluence. There were people that went short. The data said watch out above, and it closed up more than 1% above the open, just powering through. So there's one example. Here's another one here. Daily charts at the start of February 14th. So a couple weeks ago, I don't know if y'all remember, this was the Friday right before President's Day weekend. And one of the members in my room commented that his notes showed 17 of 22 most recent Fridays ahead of President's Day weekend have closed down. So his thinking was, we're stretched, we're running into some resistance, this is an opportunity to get short. 17 out of 22 is pretty darn compelling, right? 22 is not necessarily statistically significant, but it's getting close after prior day hit the resistance. Here's what the data showed. This is the most current version of the closing odds database I've got. Small gap down, open below 1824 in the ES. Spider open below 183. They generally align. 61% odds of closing above the open that day for the ES, 59% for the Spider. 512 trade, 0.28 profit factor for the ES, 1.22 profit factor for the Spider. So total agreement. And again, 60% odds are actually better than they sound, because it means there's a 40% chance of it closing below the open. That means there's a 50% greater chance of closing up that day. So what a small sample size, 5 of 22 closing up, showed was actually inferior. So the odds clearly favor the long side. And sure enough, it powered right on through, no problem. The low was pretty much in that morning. That wasn't a huge day. It was only up 12 points. But still, it's some pretty powerful information. All right, so you're thinking, how can I track all these factors and the historical odds for a given day? Well, you can use a back testing application. I use TradeStation. It's fantastic. Or you can use an Excel spreadsheet. That's how I started. Dumped data 10, 11 years ago from Yahoo Finance on the Diamonds open TradeStation. After you do that, if you use a spreadsheet, then you got to track the daily closes and open price to determine that day's odds. Or you can use my free daily research. There are no hooks at closingodds.com. It's my personal research delivered to your inbox nightly. You sign up for these four. These are the current markets. There's a lot more coming. We just turning this on, and we're doing a soft launch in November. No need to track key levels of different market conditions. And I know this is a little bit confusing, so let me say it, and this will conclude the formal part of the presentation. We'll open it up for questions. For a copy of these slides and the free daily odds, go to closingodds.com. So you'll get free instant access. I'll show you the numbers for tomorrow, show you what it looks like. And then tomorrow, if you sign up tonight, tomorrow you'll get an email. And and that email will be from Closing Odds. We'll have links to your free research. So you won't have to log in each time. We'll just go straight there as long as your cookies are on. And at the very top of that email will be the link to download the slides. So when you get an email from Closing Odds, look at it. You'll see the slides available for download. But again, I'm a nice guy. I am doing this in part because a lot of people have given very, very freely to me, and I had members help me create this research. So that part of that propels me to try to do something good. On the same token, I do hope that, if this is an easy way for me to introduce you to probabilities and probability-based trading. If you like that, you'll check us out at masterthegap.com. That's all I'm trying to do. They do have a paid version, by the way, at closingodds.com. You're welcome to sign up there. We don't push it at all, quite frankly. It's really for people that really want to see all the data and the breakdown for all the different systems. Sorry about the audio. Wish I could do something there. But at this point, right on track. I'll open it up for any and all questions. I'll show you, go ahead and fire your questions away, and I'll show you the Closing Odds site, what it looks like. And this is the data for tomorrow. So this is the ES, Spider, E-mini Dow, Diamonds, NASDAQ Futures, Qs, Russell Futures, and Russell Index. And you break it down to the three different gap sizes, small, medium, and large. We've already done the math for you, so you don't have to keep up with the 5-day average true range or anything like that. These are the gaps up. These are the gaps down. If you look at the numbers, it'll be very obvious and intuitive to you. Eastern time. And those are the odds, the weighted average odds for my 5 systems, and the number of trades to give you some confidence. I do want to make a note, on these smaller sample sizes, you do need to be careful. You never want to get too aggressive. When the market makes extreme moves, and I see small samples like this, I'm not afraid to trade it, but I almost always reduce my position size. Volatility after the open tends to be higher, and it's just less trustworthy data is the way I look at it. Oh, hey, John. Glad to hear old Zoomian here, and I had to move on from ICE after his nice heckling. Does this work as well for individual stocks as it does for the markets? Jim, I don't know. I'm not trading individual stocks, so I would not ever say something did if I didn't do it firsthand myself. But I have folks that are using it that way. The key, though, that they're telling me, and it makes total sense, is that this data will only help you with an individual stock to the degree that that stock's historical trading performance is correlated with one of these indices. So Intel probably moves lockstep with the NASDAQ 100. Apple may not. I don't know. Procter & Gamble probably moves lockstep with the Dow. I'm assuming that it's in the Dow 30. I don't even know. You get the idea. So there are plenty of sites, too, that you can do correlation analysis or even broker. Yeah, you can use this information. So really there's 2 ways to use this information. I'm using it, and many of my folks at Master, this information, so by the way, is all available at Master Gap as part of membership with some more detailed data and intraday stops, but it's more for intraday trading. Closing Odds is really designed for people swing trading and looking for some broad biases. You can day trade with it. I wouldn't use this only, but it's meant to augment maybe something you're doing day trading or swing trading and help you make better decisions in that regard. So yes, you can use options and swing trade and use this data. A lot of people are using weekly options, and they find this gives them a nice edge. Any special comments about the Qs? No, there used to be 4 Qs. Now there are 3. I'm sorry. I just don't trade. I don't trade them. That was terrible. I'm getting punchy. I told Steve I get goofy after 9 and must be hitting me early. I'll blame it on the meds, but I'm off the meds now. Maybe I'm drinking too much water. I don't know. Yeah, thank you. This is all closingodds.com. I think if you go to closingodds.com/free, it's the actual login page. Lisa says, did you say earlier that this does not work for high flyers and big ATR such as Apple, PCLNN? It works with anything that correlates well with the indices. And what I mean by that is if you put a chart of Apple and when it goes up, when the Nasdaq goes up, Apple goes up, and vice versa. Now, granted, it's a component, so it's probably driving that to a large degree. But as long as that is a very high correlation, you can mathematically calculate or visually look at it. If they have similar chart patterns, just different price points, then it's highly correlated. If you put, I don't know, again, I don't trade any individual stocks. Netflix on, I mean, Nasdaq's gone straight up for 3 or 4 years, but if you put Netflix or put a biotech stock on a biotech stock that has clinical trials and some big news that came out, it's probably going to be all over the map and not correlate well with any of these. That would be my guess. So that means it would not be helpful for a biotech stock. Yeah, I'm not complaining. Believe me, I'm a blessed man. It was way. I had back surgery a couple of years ago, and I thought that really wasn't that bad. I had lumbar fusion, but man, this kidney surgery was something else. Oh, thank you, sir. Appreciate the nice words. Trying to catch up on questions. Oh, thanks, Mark. Thanks for your service. Paul. Appreciate the nice words. Can you select an individual stock and show us how to use your data to make a decision? Let's just assume that it correlates the index on your choice for the exercise. Sure. Does this work with OTC microcap trades, say less than $10? Michael, I wouldn't think so. If it's highly correlated by chance, but I wouldn't trust it for that. So for trading the E-minis, this information can help determine market direction. Trading the E-minis or the ETFs, this information will help. Now, we'll be rolling out some of the stocks. So I know the ones that, the Apple's probably not as correlated as we'd like. I'll be rolling out Apple, Google, some of the stocks. At some point, we've got a lot of requests for that. There's actually a form. You can give us feedback, and we request that you tell us what markets you want us to roll out next. Let me go to just somebody name a stock in the Dow. I don't know if Intel is or Procter & Gamble. Is Procter & Gamble? IBM. There you go. That's a good one. And I know I don't like the Dow, by the way, because it's price weighted, not market cap weighted. So there's the chart of the YM. I'm going to go with IBM now. We'll have to pull up the data. Because IBM's been doing its own thing. Good grief. Anyhow, but it's generally trading, so it's been moving in the same degree. So what I would do if I wanted to trade IBM using this data, you're going to have to know the 5-day ATR for it. So you'll have to insert, depending upon the platform you're using, I'll find ATR in here somewhere. I use 5 days. Okay, the 5-day ATR closed today at $2.15. So that means it doesn't move much for one, but it means the average movement each day, high to low, inclusive gaps, has been $2.15. So I would pull up my calculator, which fortunately I don't have to do. I can get close enough here. 40% of $2.15. Could put us at basically an 80-cent gap. So anything up to 80 cents in either direction would be considered a small gap. Anything between 80 cents and $1.60 would be a medium-sized gap. Any gap greater than $1.60 would be considered a large gap. So I would then come back to the data. Let me pull up closing odds. Look at the Dow, and let's say tomorrow morning let's say we just have a big gap up tomorrow. Market is stretched, but let's say we have a big gap up that's greater than 80%, okay, in the Dow. So it's opening greater than 165.43. Well, I would anticipate, because the IBM is highly correlated with the Dow, that unless IBM's just off earnings or something, it should also have a very large gap. I would double check that. At 9:30 a.m., I would write down the price to see where it was trading. And if it was trading greater than, the gap was more than $1.60 roughly, right, 80% of that 5-day ATR and IBM, then I could simply use this as a proxy because it's highly correlated. I'd say, hey, odds favor the Dow finishing up 65%, or 65% of the time the Dow was finished higher. That's pretty good. It's made about 40% more in profits on 50 trades. Not bad. If IBM is gapping up comparably, then I certainly don't want to go against. I don't want to be shorting IBM unless I am awfully confident it's not going to move in alignment with the Dow that day. Otherwise, I'd bet on IBM tracking and moving quite a bit higher that day. Vice versa, and this is not a typo, and I want to explain this to you. You'll see this a lot. For whatever reason, these mid-sized gaps are really dangerous. They will be very, very volatile. They're the trickiest of all, between 40 and 80 cents, or 40 and 80, between 80 cents and $1.60 in IBM. It shows 50-50 on closing higher, actually a little bit lower than 50%, and it's made more money to the short side. It's lost money going long. So a mid-sized gap is likely to falter, but a real powerful gap is more likely to trend up that day, at least based on history. Can I make the chart bigger? I don't know that I can. You ought to be able to adjust your what you can see on your end through Omnovia. I don't know if I can zoom. Maybe I can. Oh, wrong way. I can't change it anymore. Sorry about that. Oh, thank you, Mitch. Appreciate nice words. So that's how I would do it. Have I tried calculations also take into account if the gap is out of range? RT, I don't understand what you mean out of range. There's no scenario in which a gap would not be met by one of these criteria for each of these markets. Right? It's either going to be greater than, for example, Spider's either going to gap up greater than 189.62 or between, now it could land on one of these, and we always defer, I personally, when it lands precisely on a level, well, actually, no, this covers it too. So if it's got to be greater than that number. If it lands right on 188.89, then that's still down in this bottom level there. And by the way, I've got educational videos explaining the ins and outs of all this on the website for free. How would you use information trading futures, E-minis? Well, that's what I'm trading every day, Richard. I use what I do is I trade the gap. I look at the end of day data for one. I always prefer to see that I am fading a gap. So if the gap is up, I'm shorting it, or gap is down, buying it. Not only with my systems favoring gap fill, but I want to see the end of day odds favoring closing beyond the open as well. That's not a requirement for me, but it's always nice to see. And then once I get into the winning trade, if it is favored, let's say there's a gap up, I'll go to today's action. This is my busy E-mini S&P 500 future. So we gapped up right here today. I can zoom this in. So we had a pretty sizable gap up. It wasn't quite 40% of the 5-day ATR. 40% of the 5-day ATR today was actually 8 points, right up to about 1880. So we gapped inside what would be a common gap. And I can't show you what the data showed, but it showed 50-50 on which way we were likely to finish the day, and slightly bigger moves to the downside than to the upside. So it didn't really give me much of a cue today. What I was hoping it would show me, because I did short today and held the thing all day with a 6-point stop, so I survived by 2 points. What I would have preferred to have seen, and the ones, my gap trades that work best, is when the odds of closing below the open are, say, 55, 60, 65% chance of closing below the open. So vice versa, only 35 to 45% chance of closing higher. That's what I want to see to be shorting. And I want to see that it's made a lot more money to the short side than to the long side. If you go long on an index that gaps up and meets criteria, you may get it at the gapped up price. Then it retracts and you still lose, but it's still closed above the last price. Hey, Rod, that's a great point. So, yeah, this is not accounting for, and I'm not suggesting you do that. This is not accounting for intraday stops if you get stopped out. So, again, you're welcome to, whoops, hold on. I'm trying to get back to my home page. I don't even know how to do it. Oh, here we go. That's what that home button is. If you want to see the detailed stuff, I've got it in here somewhere. Yeah, advanced and premium. See how the stops show up? So if you want to see those same stats with not just an end-of-day stop, but an intraday stop, and I use 30% of a 5-day ATR for most of my trades, then you can do that. But again, I suggest you start off with just the end-of-day odds and get comfortable with the probabilities that I'm showing you. We're about to run out of time. Whoops. Just a couple more minutes. Membership is free. To sign up for the free data is what I suggest you do. As a gap trader, gap fader, back testing has shown me a minimum stop of 5 points in the ES or 50 cents in the spider is optimal. Some people tell me that stop is too big, and I say, well, you must like low win rates. It's a trade-off. It's an inverse linear relationship, meaning the bigger your stop, it's a direct correlation. The bigger stop, the bigger your win rate. The smaller your stop, the smaller your win rate. The profitability is almost identical over the long term. I've done tons of testing on it. It doesn't matter. Stops are to make you feel good and to achieve the win rate you want. That's not how you make your money as a gap trader, in my opinion. Is there a difference between a trade saver stop and an account saver stop? Sure. You should have a money management stop on every single trade. And if that money management stop for that trade, not call it money management, just a stop, right? The stop that preserves your profit expectancy for that trade. If that stop size, say, is 6 points in the ES or 60 cents in the spider, but you're on a drawdown, and if you have one more loss greater than, say, 4 points, then you shouldn't take the trade. I would not take the trade. It doesn't make any sense to me. So it doesn't meet your criteria. You got to regroup, take a break, and change your position sizing, do something to change the dynamics. The slides are not on the website. I need to get them loaded, Trade Tricks. They're actually going to be in the email you will get tomorrow. So once you sign up, you'll get an email tomorrow with tomorrow night's links, and at the very top of it, you'll have a link. And I just need to get them on the website. I'm sorry I don't have them there yet. I'm using TradeStation for my charting and back testing. The gap up at an extreme overbought is predictive as one that occurs at an extreme oversold level. I don't find either extremes are very predictable, other than, a gap down after is a gap up. A gap up in extreme overbought is not as good of a fade. Let me say it clearly, Jay. Market is overbought. We're overbought now. So if we get a big gap up tomorrow, that's a decent fade, more than likely. If we were the opposite, if we were down at those recent lows we had a month or so ago, and you had a big gap up, you would not even think twice about fading that. You'd want to follow that gap because that has a very high odds of closing higher based upon the data I would have sent you. So a fade, down to about 1 more minute here, and I just want to be cognizant of Steve and his team's time. For me today, I went short. I had good data that favored fading the gap. So a gap up today. I went short at the open with a market order like I always do. Yes, that's a little different, a little contrarian. No, I don't get much slippage in the ES because I'm going the opposite direction of the prevailing trend. So sometimes I have positive slippage. I had a ticket slippage today. I got filled 1876.75. I had a 6-point stop. My first target was 1874.50. Second target was gap fill. First target was hit. Tightened my stops to 2 points above my entry, and I was, or 2.25 points above my entry, and I was stopped out 1 tick below the high there for a scratch trade. So fade, I'm looking to target the price back at the prior close. If the gap is up, I'm shorting. If the gap is down, I am buying, if it meets my historical criteria. I recommend fading a gap when my 3 systems all line up. And that's it, match the gap. A large gap up tomorrow favors a continuation on the ES. We'll finish with the last thought so you can see if it's right or not. 2 times out of 3 it is. And a large gap up in the ES does favor closing higher. It's not confirmed by the spider. I do like to pay attention, and that gives me pause. Why would the ES show strong numbers and the spider not? That's a little bit unusual, so I'd be careful on that. The average of the amount is not very compelling. A mid-sized gap up is 50-50. A small gap up only has a 47% chance of closing higher, and a 0.7 profit, I can tell you, it's lost money going long. So you might want to short an up gap if it's small enough and hold for continuation of the downside. A small gap down, opening less than 76.50 but above 69.36, has a 62% chance of closing above the open. It's made 35% more in profits than losses. I do have a trading room. Check it out on your own. But folks, I appreciate your time and interest. I appreciate Steve being a gracious host as always, and hope I haven't confused too many of you. There's some good data. I'm sorry about the sound tonight. We can't control that, but I wish you all the best. Check out Closing Odds if interested, or consider creating your own data similar to what I've done here. And again, good trading. Take care.
Scott.